Well, it's wonderful to be here today. I'm surprised to say this is actually the second comedy club that I've talked about the economy in this year, if you can believe that. I actually had one where the Q&A was yes and people would shout out a word and then I'd ask somebody else to shout something out, and that's how we did the Q&A. I find sometimes the more challenging the economic conditions, the funnier people want things to be. And so that's why I think it's really important to maybe start with some of the good news. And the most important thing I could say is we're thinking about the economy right now in the long term. I wear two different hats, right? Prestige economics, we do financial market research. We're looking at that sort of 3-year out period. The Futurist Institute, we look longer out. When I talk about longer term things, the outlook, those longer term trend lines often make us a little bit less concerned about what we might see as some pretty horrific short term headlines. So the good news, especially because we're here, like we might as well do this, let's talk about the population in Texas. So between 2017 and 2047, population in Texas is expected to grow by 60%. By the way, these are forecasts from the Texas Comptroller and the Texas Demographic Center. GDP, or GSP, gross state product, in real 2012 dollars, going from 1.7 trillion in 2017 to 3.7 trillion. So 120% rise in state GSP is what's currently being forecasted through 2047. That means GSP per capita in 2012 dollars goes from 2017 around $58,000 to $81,000. That's all deflated. That doesn't include any inflation. That's all in 2012 apples to apples. What does that mean? Well, in 2012, that would have made the GSP of Texas in 2012 dollars, 3.7 trillion would be 300 billion more than what Germany's GDP was in 2012. So that would make Texas the 4th biggest country in terms of GSP. For per capita, it would be number 7. So it's further down the list, just below Bermuda, but above Switzerland in real 2012 dollars by the time we get to 2047. So I'm pretty optimistic about this. I'm optimistic about a lot of different things in the Texas economy. We look at Austin. This is the GDP numbers. Austin is the green line below the other two. The red line is Texas. Sometimes it's below the black line, which is the US. The most important part is, generally speaking, Austin's always below both the US level and the Texas level. So this is a great place to be, and no matter what happens, it's probably still going to be better than many other places we could be. And that's the good news. So now let's get to the other news that we kind of need to talk about, right? So the long term looks really good, right? We think about a state GSP where this would have been in 2012, the 4th biggest economy in the world. And we think about having people with individual GDP per capita above that of Switzerland. That all sounds really wonderful. Now, in the short term, there's some upside and downside risks. Upside risks are we have a strong labor market, services have been contributing to GDP, and there is a solid manufacturing backlog. So manufacturing has slowed. It's much worse in other countries, right? So in Europe, they're contracting. We look at China. China's manufacturing has contracted in 6 of the last 10 months. So that's not good. But in the US, manufacturing is still expanding somewhat, and there's a massive backlog. If you've tried to order any kind of industrial equipment, you're probably still being quoted in weeks that exceed the number 52. On the downside, the economy is contracting. We've seen 2 consecutive quarters of contractions. We expect it is conceivable that we could see from here another 4 quarters consecutively of contractions or more. The wealth effect is reversing. One of the biggest ways you get economic growth in the economy is people feel wealthier. The stuff they own, the things they invest in, they go up in value, you feel wealthier, you spend more money. The problem is, if the value of everything goes down, people feel concerned, they don't spend as much, and GDP is over 70% people buying stuff, consumption, 70%. So when people get nervous, that's not good for the lion's share of GDP. More Fed policy tightenings ahead. We just had 75 basis points. We're probably going to get another 75 at the meeting in early November, maybe another 75 or 50 in December. We're going to see a lot more higher interest rates here. Mortgage rates could easily be 8% by the end of the year. Year-on-year inflation is likely to remain elevated. Some of the things are pulling it down now. We've seen some decline in oil prices from where we were in the middle of the summer, but natural gas prices are going to be a really big issue this winter. We'll talk about that in a second. For many corporations, there are these scavenger hunt economics that are going on. In other words, you're trying to get the stuff you need, and then there's some components, then there's, oh no, now you don't have the people, and now you got to find the stuff, and you're on this perpetual scavenger hunt because there's scarcity of labor, commodities, physical goods, things you've been importing from almost everywhere. All of those things present a scavenger hunt for most businesses in operations that are in manufacturing, logistics, supply chain. Any of those industries are really struggling. High labor costs are likely to persist. And Cold War II is here. We've been expecting it, which is why that's now actually a registered trademark we have, right? But it's here. So let's talk about inflation. Right now, 8.3% total CPI. That's all the goods that the average person buys. That's the blue line here. It's come down a little bit, but it's still really, really high. The line below that is core inflation excludes food and energy. Fed Chair Powell in August at Jackson Hole last year used the word transitory in his speech 4 times when talking about inflation. Now, obviously, the Russian war in Ukraine and Cold War II have added inflationary pressures. China's biggest export of the last 25 years has been deflation. Their manufacturing has contracted in 6 of the last 10 months because of the zero COVID policies. This year at Jackson Hole, Fed Chair Powell struck an almost Churchillian tone in regarding the war on inflation. There's a job to do. We must do the job. The job is not done. We will do the job until it's done. What's the job? To get it back to 2%, that's the line that doesn't fit on the graph over here. That's where the Fed wants to get inflation. We can get there fast, but we won't enjoy that. And it's high, right? To give you some idea, even right now, year-on-year CPI is the highest since December of 1981. And I think most of y'all kind of remember that, but like to put it in perspective, and for those of you who may, like you may have only seen one of these in an escape room, like for the younger folks, right? Like this is a phone, right? But even for those of us who remember these, in December of 1981, you still rented these from Ma Bell. You didn't even own them. So it's been a while, right? And the Fed funds rate's on the rise. Which brings me to the thought that only a recession can save us now. And that's the bad news. The good news is we don't have to wait. But that's also like not great news. You can see GDP the last 2 quarters contracted in Q1, down 1.6, in the second quarter down 0.6. There's a debate, are we in a recession, are we not? It doesn't feel like we are because the job market is super tight. But there has never been a time where we had 2 consecutive quarters of negative GDP and it wasn't defined as a recession. Never. Now, GDP right now, or at the end of second quarter, was still higher than it was in Q3 of last year, because Q4 was just a monster. So it's some give back in Q1 and Q2, but it wasn't the same stuff that dropped in each of those quarters. In Q1, net exports fell, goods consumption fell, inventories fell, government spending fell. The only things that went up were services consumption and investment. in Q2, it changed a little bit. Net exports went up, services consumption went up, and everything else went down. So there was a drop in goods consumption, a drop of investment, a drop of inventories, and a drop in government spending. This isn't like one thing going down. It's a bunch of stuff. And investment isn't likely to get better with much higher interest rates. So if we see consumers lose confidence, which is something we've seen, which leads me to the point of what is a recession. It's not a recession unless it comes from the recession region of France. Otherwise, it's just sparkling economic pain, right? And what does that then mean for where we are, right? Because the GDP now shows, this is an adaptive model the Atlanta Fed produces, GDP Q3 likely to be plus 0.3%. I think it's probably going to be negative, but plus 0.3 is in the cards, could be. But the consumer confidence numbers make me seriously worried. In June, we had the lowest University of Michigan confidence number ever. This is a 70-year series. That means in June, now it's come up a little bit, but it's still near that all-time low. How low is that? Well, that means consumers were less confident in June than they were during the financial crisis or after September 11th, but also less confident than when the Berlin Wall went up, during the Vietnam War, the tail end of the Korean War, any of that stuff. So that's not a good sign because this is 70% of GDP. That's what consumers are responsible for. If they're not confident, it's a problem. So the reason it might not feel like a recession is the jobs numbers. And we've seen that really the jobs numbers are really good. This is the unemployment rate, right? Not many people are unemployed. Unemployment rate right now, 3.7%. Before COVID, it was 3.5. You can see on the graph, it's super low. People have jobs. Right now, there are more workers on private payrolls than before COVID, right? This is, by the way, as we sit here right now, there are more people on private payrolls than in any other time in the history of the United States, right now. We look at jobless claims, pretty low. Recent number, 213,000. That probably understates labor market tightness. Why? Well, the record low was 162,000 November 30th, 1968. The labor force has increased 108% since then, right? But yet the number of jobless claims is only 30% more. So on a labor force adjusted basis, this is the tightest job market in US history. It's part of the reason employment costs are up. In Q2, employment costs up 5.7% year on year. It's a lot. It's a lot less than the 8.6% CPI inflation in Q2, but it's a lot. So where did the workers go? Few places. So workers are changing jobs for real wage increases. This is some data from Pew Research. Between April of 2021 and March of 2022, people who switched jobs and went to a new employer, 60% of them got real wage gains. In other words, they got paid more than inflation. Last year was 51% in that same time window, from April 2020 to March 2021. If you stayed at your same employer but I got a different job, less than half of those people between April of 2021 and March of 2022 saw real wage gains. You get a promotion, another job within your company, you still don't beat inflation. That's lower than it was in the prior year. It says a lot. I'm sure the boards you're on, the companies you work with, we're having trouble retaining people, we're having trouble hiring people. And you end up with penny-wise, pound-foolish decisions where, well, this person wants a 10% raise, and they're going to go somewhere else. But if we do, other people might find out, and then they might try to get other jobs. Inflation in Q2 was 8.6%. Asking for a 10% raise in an 8.6% inflation environment is not a really big increase in real terms. That's the challenge. If we look at the help wanted online numbers, oh man. We look at the jobs online, 2 lines on this graph. The upper line, the red, that's the employment number. That's the millions of people working. It's the right axis. The blue line, which is below that, represents an index of the number of jobs posted online. Now, before COVID, there was about 8 million more people employed than the trend of the jobs posted online implies. Okay? So if we put that above where the job postings are today, say, okay, there was an 8 million shortfall before, let's say there's an 8 million shortfall now, but you'll notice the red line is actually below the blue. So you need to actually eclipse that. There's actually probably, based on the postings of jobs online, a 12 million worker shortfall right now. That's a really big number. Now you've got redundant postings and these sorts of things, but you had that before as well. There's just a lot of open jobs. And then there have also been some changes in the labor market. And by that I mean, in 2001 I came out of grad school for the first time. Really bad timing. I ended up waiting tables. The minimum wage is still $2.65 for waiting tables. I would probably not do that today. Like today I would be doing what a lot of people do. You drive for Uber, you work for one of these bunch of food delivery apps that loses billions of dollars every quarter. And you know, I'd be trying to make my dog a dogfluencer, right? Like I'd be doing this all day, right? And I don't know why he has a Tinder profile up there, but like whatever, like I don't ask questions. But I'd be trying to make my dog a dogfluencer. And I'd probably make more doing those things than if I waited tables. So for a lot of young people, they're looking at this. I know a guy, he makes a few $100,000 a year, and he does karaoke on Twitch. And he makes, like, people watch him sing songs. It's not like TikTok with lip sync, he's actually singing. He makes several $100,000 a year, and he makes like $3-4 grand a month singing karaoke, and people can, you know, doing this like a couple hours a week. He doesn't need the money, but if that was all he was doing, he would certainly not be waiting tables or taking other jobs that are labor intensive. So you've probably heard lately that there are problems in the labor market, and I want to talk a little bit about this. People say that the labor force, all these people have left, and yes, for all the joke about the dogfluencers and the whole thing, right? The biggest labor force in US history ever is for the most recent date in August of 2022. The labor force has never been bigger than it is right this second. About 165 million people. It has never been bigger than right now. So why are there labor issues? Let's talk about it. So let's first define just a couple things, just for a second, make sure we're there, right? So there's the population of the country, and then there's the civilian non-institutional population. This is where we get the labor force from. This is every person who is 16 and above. There's also no upper age limit, but it's age 16 and over. That's people who could be in the labor force. And then there's two kinds of folks who are in it. People who are employed and people who are unemployed, as defined as you're collecting unemployment or you're looking for a job. But you must be looking for a job or you're not defined by the Bureau of Labor Statistics as being unemployed. You're considered not part of the labor force. So you either have a job or you want one. That's who's in the labor force. We look at the country overall, the labor force participation rate, so not the absolute number, but the percentage, peaked in 2000. Today, it's about 62.4%, and you can see it hasn't fully recovered from COVID. And the thing I often hear is, well, there are all these young people, they don't want to come back to the workforce, this sort of thing. Ages 16 and 19, that peaked in the 1970s. It's been falling since, but if you look, since the Great Recession, it's been going up. And the 16 to 19-year-olds they've been the quickest group to recover in the wake of COVID as participating in the labor force. Now it's still low, and you might say, well, why is it low? And we'll come to that in just a second. We look at ages 20 to 24, this peaked in the mid-80s. It's recovered somewhat since COVID, but not completely. But it peaked decades ago. So what happened? What happened is we wanted people to graduate high school and college. So of course, the 16 to 19-year-old, the percent of them working was at their peak in the 1970s compared to where we are now, because if we look at the percent of people who were, these three things show, this is less than high school completion, the middle is high school or some college, the top is bachelor's degree. And you can see the percent of folks with less than high school has gone from, in 1940, almost 76% to 10, and for high school, some college, from 10 to 55, and bachelor's degree or higher from less than 5 to over a third, 34.3%. So if you want people, if we believe we live in an intellectual capital economy, and we want people to get education, they're not going to be part of the workforce. And why do they graduate? Why do people get additional education? This is data from the US Bureau of Labor Statistics. You can see every level of education that goes here. This is from less than a high school diploma up to a doctoral degree. The unemployment rate is lower every step you move higher. For wages, it's the same, although doctorates and professional degrees sometimes alternate a bit. Every time you get more education, you earn more money. So the more you learn, the more you earn. So we're going to probably continue to see relatively low labor force participation rates for 16 to 19 and 20 to 24-year-olds. But again, 20 to 24 is pretty much recovered. 16 to 19 is higher than it was before COVID. So where are the missing people? I won't talk too much about this, but you can see also, if we look at the college education piece, back to 1970s, 8% of women graduated college then. Today it's 39% for men. It was 14, and today it's 37. That's what we want for our economy, right? So this is an important part of that. If we want to have a technologically advanced economy, people need to continue to pursue education. So let's talk about the missing workers. Ages 25 to 54, this labor force participation rate has been between 80 and 85% since the 1980s. It's higher now than it was during the worst part of COVID. It's almost back to where it was before COVID. It's lower than it was, though, in 2000. But that's still not who's missing. The folks who are missing are over 55. If you look at the labor force on the right, you can see right now at 38.6%. Compare that to 82.7 for people in prime working age, 25 to 54. You can see 38.6%, and it has not recovered to where it was before COVID. People saw their home prices go up, stock prices go up, and they retired. And by the way, in 3 years, baby boomers start turning 80. In 3 years, in 2026, Gen Xers start turning 61. So, we see those over 55 folks, they're probably not coming back. And I know there's a huge labor shortage in manufacturing and construction. These are not the ideal candidates for construction, I'm just saying. Right, so, now we've talked about those kinds of things. There are a couple other things I'm a little bit concerned about. Layoffs are up year on year. Now, the big, huge bulge in the middle of this graph, that is the COVID period, so that kind of distorts it, but we are up year on year. You can see it a little better when we look at startups. This is from layoffs.fyi. And you can see here, this is Q2 2020. You can see the red bars are the number of employees laid off, and the blue are the companies with layoffs. And you can look to Q2 of this year and Q3 of this year. Q2, Q3 this year combined is worse than Q1, Q2 of 2020. So the layoffs on the startup side, and this has something to do with the cost of capital and a number of other things, but it's worse now than it was in the opening salvos of COVID. Which brings me to Cold War II and inflation. So why were so many people thinking inflation was going to go down? I never used the word transitory, but I also expected we would see some lower inflation this year compared to last year. And part of the reason for this was Cold War II. On February 4th of this year, China and Russia got married. It's not like one of those happy weddings. It's more like a Game of Thrones kind of wedding. So they're at the Olympics, And Xi and Putin put out a statement, and they say that there are no limits to the cooperation between the two countries, and that they support the outcomes of the Second World War, which, was a while ago, right? 1945. So why are they making this statement now? And if you look at this graph from the UN, it becomes clear, right? Russia bigger, China bigger. And that's how we end up to where we are now. Because Cold War II inflation engendered on the left food prices, both food and cereal prices to go up sharply, and on the right, oil and natural gas prices to go up sharply. No matter what Fed Chair Powell does, no matter how many interest rate hikes we see, you will not end up with Fed policy leading to Biden and Putin, Xi and Zelensky sitting around a campfire making s'mores singing Kumbaya. And if that's not going to happen, this inflation is going to be sticky. In other words, the root cause of some of the inflation is more than just monetary policy and fiscal policy. This is natural gas. You can see it's gone up quite a bit. This is monthly prices. Probably going to go up quite a bit more this winter. Power, nat gas, going to be very expensive. Much more expensive in Europe. Expensive here as well. You're going to see interruptibility contracts triggered in Europe. You're already beginning to see that. You're going to see quite a bit more. How dependent is Europe on gas? I know it's difficult to see the colors from here, but this varies from 0 to over 40% reliant on Russian gas. Hungary's in the 40+% category. Central Europe is 20 to 30 to 40%, depending on the country. Heavily dependent on Russia for natty. Now we're sending a lot of LNG over there, which is helping, but it's not going to be enough. And that's also making our nat gas more expensive. And with that nat gas price chart, I would point out, right, the weather is pretty mild out. It's pretty mild in most of the country. What happens when it's actually cold? It's going to go a lot higher. And then there's the cost of money, which Fed rates are going up, but that's having knock-on effects with other levels of cost of capital. We've seen the dollar strengthen significantly. This is impacting commodity markets and equity markets. We've also seen the impact to be a widening of the 10-year, 2-year spread. This is the difference between the yield on the 10-year bond minus the 2-year treasury. What does that 10-year treasury minus 2-year get you? You can see over time, going back to the 1970s here, the gray shaded areas are recessions. And what you can see is, well, we're below the line quite a bit here. Whenever that happens for a protracted period at this depth of widening, you're either in or about to be in a recession. 10-year treasury now at 3.88. Right, last year at this time of year, it was almost near a record low, between 1 and 1.5%. High yield bonds, finally in the money. They just recently have begun to exceed the inflation level, but these are junk bonds at 9.43%. Triple C and lower, that's up a lot too. That's 16.63% as of the 27th of September. What is this? Triple C bonds typically are considered to have a 50% default rate. So yeah, you can get a 16, 17% yield, but you will lose half your principal on average. So not a great deal. And then there's a part of where this debt thing fits into the Cold War II elements. So debt to GDP ratios are extremely high. On the left, you see public debt. On the right, you see private debt. Several different lines. Advanced economies, low-income developing countries in green, emerging markets in blue. The important part is, on the right, you can see they're all at or near record all-time debt to GDP ratios for both public debt and for private debt. Everyone took on a lot of debt during COVID, and now, as we just saw, the cost of money has gone up. So if you've taken on a lot of debt, and now you're paying much higher rates, so for example, this is triple B emerging market bond yields, 6.56% on, actually not the 27th of July, the 27th of September. Last year, 2.78%. Single B and lower, emerging market bonds, 27, oh, I think we might have lost, oh, there we go. 17.54 last year, 11.03. And I'm sorry they say July, they should say September. Last year, 11.03. So that's pretty high, right? If you're paying for single B and lower 17 to 18% on emerging market bonds, that's a problem. And we see emerging market bonds that are held by banks at the highest levels in 15 years. So banks in emerging markets are holding lots of emerging market debt. And the cost of that debt is really, really high. And if we look, who is the bank for all this debt? China holds 70% of emerging market debt. So China's the bank. Everybody has a lot of debt. Interest rates are super high now. All of that is a recipe for problems. It's also complicated by the fact that many institutional investors had investments in Europe, in Russia, and when Russia invaded Ukraine and we saw sanctions and exclusion from the SWIFT banking system and all these other things, a lot of those investments in Russia went to zero. So if you owned Russian iShares or something like that, gone. Russian economy is not that big compared to the Chinese economy, but what happens if China ends up getting a little too handsy with Taiwan? What happens if they send certain kinds of lethal aid to Russia in their fight against Ukraine? These questions are troubling for pension funds, institutional investors, and corporations that have operating facilities in China. What happens if tomorrow Cold War II goes full-blown and now everything you own over there is just not yours anymore? It's a smaller risk after Biden and Xi had a call in March about third-party sanctions, but it's still a pretty big risk. Especially you see, it seems like almost every week there's some crazy headline about China and Taiwan. This goes sideways, all the investments and assets and facilities you have in China might not be yours, could go to zero. And that's why this graph shows foreign investors fleeing China. This is from earlier this year. We're waiting on an update of the data, but just the capital outflows out of China have been significant across asset categories. Now let's talk about a brighter spot, which is, we're talking about problems in China, we're talking about problems in emerging markets, US housing and consumer debt. So there's some bad news and some good news. So the bad news is mortgage rates are rising, they've risen significantly, they're going to go up more. Single family home sales have fallen, they're likely to fall further. Median home prices are falling, but they're still near very, very high levels. And this is the good news. Mortgage credit has never looked as good as it is right now. If you look, this is mortgage origination in various quarters by credit score. The light blue at the top are mortgages for people with 760 plus credit scores. Those kinds of credit scores don't fall out of the sky. And you can see in the last couple of years, it's been between 2/3 and 3/4 of all mortgages that are 760 plus credit scores. That's very different than the colors of the bars on the left side of the graph before the housing crisis. So mortgage debt is in a much better spot. So even if we're seeing mortgage rates going up and home sales and home starts falling and some weakness in home prices, the credit quality is so good of the people who bought the homes that it's a much smaller risk that we would get another housing crisis. So good news, we learned something from the housing crisis. I would add to this good news as we think about leverage and say, look, in the US, our household debt to GDP is between 70 and 80% right now. Going into the housing crisis, it was 100. So on a debt to GDP basis, we're in much better shape now. Furthermore, If we look at credit delinquencies, this is the percent of all consumer debt that's delinquent. The colors represent how delinquent, from the green 30 days late to the red severely derogatory. But that's, the color scheme doesn't matter. What's important is, if you look on the right, the 5 most recent quarters are all brand new record lows. The most recent quarter is the lowest quarter in history for delinquent debt of US consumers. 2 to 3%. You can see the peak there in 2009, 2010 was close to 12% delinquency on debt. So people have jobs, mortgage credit quality is high, and debt delinquency is low. These are good things. This is also part of the reason why the Fed feels confident to continue to raise rates, why the dollar keeps strengthening. There are bigger problems in other economies. If I was talking to a group that was predominantly in Europe, we would be having a much more dire conversation. If I was talking to a group that was primarily China focused, it would be very tough as well. Folks have been asking me, where should we be investing? What should we be thinking about? Look, you're already in dollars, you're already in the US. Right now, it's the best game in town by far. It's not always true, but it is right now. Key economic takeaways. So let's talk about a few takeaways, then some things to think about, like actionable insights. So, a few things. With strong jobs and high inflation, the Fed, with strong jobs and high inflation, the Fed is continuing to push ahead and raise rates. The economic outlook, though, has darkened, especially with weak, record low consumer confidence. That's not good. Cold War II, unlikely to end quickly. Bond yields have risen. I mean, when I say end quickly, I mean the odds that the Russia-Ukraine thing goes like Korea is really high. And there is still no peace treaty between North and South Korea, right? So this is likely to be a frozen conflict, goes on for potentially a very long time, right? You have an unstoppable force, an immovable object, and all kinds of pressure being applied, but quick recourse is not something we've been expecting. Bond yields, they've risen, could rise further. That presents economic, financial market, geopolitical implications. So you're board of a company, your company needs to raise capital. If you're going into equity markets, it's challenging because there are alternatives that are more attractive than when interest rates were zero. If you're going to raise debt, you're now going to pay a lot more for it. Credit revolvers, very expensive, relatively to where they were a year ago. Demographics, though, they're going to do a few different things that we should also talk about. Good news, bad news kind of stuff. They're going to see a really big impact on the labor force. You're also going to see a really big impact on future healthcare needs and what that labor force looks like and the population looks like as well. So we talked about before that the labor force is ages 16 and up, and there's no upper limit. So that 55+% of people working could go lower as we see baby boomers, the biggest generation before the millennials, roll into retirement. So that's something to be on the watch for. You're going to see greater healthcare needs and a big impact on the labor force. I haven't talked about this, but we can talk about demographics and entitlements and Medicare. If you want me to talk about like the really sad stuff, we can talk about those problems. Winning strategies for uncertainty, though, are probably the most important takeaways. Obviously, and I'm sure this is something that many of you are thinking about, talking to your companies about, just focusing on the ROI, minimizing your costs, trying to account for sticky inflation, right? The thought that it's going away quickly. You can see where the 10-year treasury is right now, right? 3.88%. That's not, that tells you there's concern that the inflation is going to be sticky. And the price wage spiral where inflation gets stuck in wages, it gets stuck in all parts of business is pretty high. The Fed's trying to fight against it, but it's tough. Also be cautious with speculative investments. I know there's a lot of things that people are very interested in as pet projects and lots of very exciting sounding things. This is, in this interest rate environment, that's a bit more risky. and then focusing on operational resilience and supply chain issues. If you think there are supply chain issues now that are problematic, they could get worse if we think about what those tensions with China could look like as we see potentially a devolving situation with global supply chain. So those things are really important to think about. And I leave you with this positive thought. You think about Texas, right? There's still reasons to be optimistic, and you want to watch the positive trend lines and plan for those upside opportunities just by being here in Austin, being here in Texas, Central Texas in general. There's a lot of upside here, so we're in the right spot, but there are some really big challenges that are affecting the economy broadly. And with that, a disclaimer, I know you're going to read it, everything could be wrong. And that's me, that's my contact info. So I'm happy to take some Q&A now. I know we've got some time, and if the microphones bear with us, like we'll do the thing. And we won't do it like improv where people just yell out random words. I feel like we can just do questions.
Thank you, very informative. We have an election in 5 weeks. How does that affect your comments?
Yeah, so thanks. Thank you for that question. I was actually up on Capitol Hill last week. I'm a member of the Texas Business Roundtable affiliate, which is called Texas Business Leadership Council, 100 CEOs who advise policymakers, both the state and the federal level. I'm one of those 100 CEOs. I would tell you a few things. One, I don't think that the outlook for the economy will drastically change the outcome. Whatever the outcome of the election is, these things are bigger than that. And I know many people would say there's nothing bigger than the midterms, but we know that's not true, right? There's presidential elections, that's bigger than midterms. But obviously stuff like Cold War II, that's on its own course, right? The Section 301 and 232 tariffs that were implemented under the Trump administration were continued under the Biden administration. The Biden administration has tightened further, right? We see that the geopolitical issues with Russia and China are bipartisan issues. That's some of the most important economic stuff. That being said, as far as the potential outcome of the election, I tend to watch the prediction market. So Predict It is a market that I watch. And if you looked back in late July, the odds that Republicans would take the House and the Senate was around 76%. And now, when I just looked at it yesterday, it was below 40%. So where did those 37 percentage points go? And it went in a turn to social issues that, based on lots of research and data, we know the majority of the country do not want changed. So the social issues, I think, are going to have a huge impact on what the outcome is. We see it in the prediction markets. 37 percentage point advantage is a pretty big, or loss of lead is a really big one. And that the social issues have become really, really important in terms of what voters are thinking about, even though right now you would think that the prime issues would be inflation and recession and that sort of stuff. And it's still a long time, a number of weeks out. You don't know what's going to happen, but the prediction markets are probably the best thing. It'll tell you what's most likely to happen. And economics are not necessarily, even though they might be for a business group or board members, might be what we're thinking about. The public has definitely turned in another direction. Yeah.
Jason, if you can go back to the slides with
Sure.
the credit scores,
Yeah.
where you showed that light blue part, and I really want to believe that. I don't think we found, maybe I'm wrong, but I don't know that there's that many people with 760 pluses.
So these include, right, so this is origination of all kind. This is refis as well as, right, initial originations. So that's probably people, I know in that time period, I refied twice, right? But the other part is still, you still saw in the last cycle just the distribution of mortgages. we're in a much safer place in general. Very few low-risk mortgages, right? So to give you an idea of the other numbers, the dark gray is 720 to 759, the light gray is 660 to 719, and the yellow and blue, which you can barely see on the graph, that's below 659. So
If it includes refis, that makes a lot.
it does. It does include refis.
Jason, I have a question.
Sure, let's do it. Jen, go for it.
So if the cost of capital is increasing and the cost of debt financing is increasing, and there's been this trend of companies going from public to private, will that change the course of that trend?
I think if you ask me what's the big implications of where we are with the cost of capital, I would tell you that not all companies know how to survive by buying low and selling high. And you never go broke by making a profit. Buy low, sell high, make money all day long. Don't tell anybody, like that's a big secret, so don't tell anyone. And not all businesses do that. And if you have to go back to the well to continually either raise equity or debt, that's going to be a lot tougher. You're going to have a lot of zombie companies. You're going to have a lot of companies that get scooped up, that go out of business. I think that's, rather than going public to private, I don't see that as the big shift in the next couple of years. I see consolidation of entire industries that have been built on the mantra, the more you lose, the more you're worth. And that works when money is like free, but it certainly isn't right now. Not for riskier credits. And if you have a DCF model with no cash coming in and higher interest rates, like that's a problem on the valuation side.
Hi, thanks so much for being here. This is illuminating and very interesting. I have two questions that are very, I think, unrelated to one another. The first one is, you mentioned the baby boomers turning 80.
Yeah.
And my question is about their retirement accounts and required minimum distributions.
Yeah.
How big a deal do you think that will be or is becoming as a driver of spending?
I don't think that's that big a driver. I think the bigger concern would be, do they feel confident taking more than their minimum, right? Because if stock prices, so I'll give you an example. And I talked to a large institutional investor group back in May, and they were for a governmental pension fund, one of the biggest in the country. And in that conversation, you know, what they're trying to do is help folks who have defined benefits pensions, but most people have defined contributions. And what that means is, for people who know nothing about money and don't know anything about equity markets, whatever, they now turn 65 or 72 or whatever, and congratulations, you are your own stockbroker. Right? I have a cousin who's a social worker his whole life. He put money into his retirement account diligently year after year after year. He was a social worker. He was not a broker. He was not a banker. He was not a finance guy. And now he sits in front of the TV, watches CNBC all day, and is concerned about, oh my gosh, what's happening with these stocks, right? It's like ESPN, where like your retirement's on the line. And that's pretty scary. And so you have a whole bunch of folks who, in the last few years, no matter what you bought, it went up. And now, no matter what you own, it's gone down. It doesn't matter. Land, gold, equities, bonds, whatever you owned, the price of it is down. Even though the yields of bonds are up, right? Price and yield are inverse. So no matter what you've owned, it's probably worth less than it was 3 months ago or 6 months ago. And so if I think about spending, I'm thinking about that swath of GDP, which is 70% of people buying stuff. I'm also concerned, and this is why I mentioned healthcare. I took these slides out because I didn't want to depress anybody, but for a number of years, the forecasted date of when Medicare is insolvent is 2026. That is still the forecast that has been for a number of years. 2026, it is 3 years out, Medicare is insolvent. Social Security is insolvent in 2034. And, you know, obviously if we have a recession and people lose jobs, there's less money going to payroll taxes, these numbers could be sooner. Those are bigger concerns. Not, with the minimum distribution. I'm more concerned that people feel confident spending, that, okay, I took money out of my account, I spent it, but everything's going up, all ships are rising, more money will be there, it's okay. And that's going to be a tougher question.
Good deal, thank you. My second question is about the UK budget, kind of the,
Yeah.
and the IMF reaction. Or not IMF, but anyway, the broader European reaction.
Yeah, so there's concerns about what's going on in the UK budget, which is part of the reason we've seen the pound just come under tremendous pressure. There's talk of moving to parity against the dollar and these kinds of things, which was unthinkable even just a couple months ago. In the grand scheme of things, I think there are bigger problems even that the UK has. One is, most people don't know, there's only 10 days of natural gas storage in the entire country in the UK. It's in the North Sea, but there's only 10 days there. And the gas that used to come across Europe, now it's coming in LNG. So these things are going to impact the UK economy maybe even more than what we might see from questions around the budget. And I don't think we know how bad that's going to be just yet. But this is why the euro is where it is. It's why the pound's where it is. In other words, we might not see these done yet falling, regardless of just thinking about Cold War II, regardless of skepticism and concern around the debt and the budget. And there's also going to be it's going to be very difficult for the ECB and the Bank of England to continue to raise interest rates. So this is the other reason the dollar is stronger, because the Fed is raising rates. Why? Job market, we got the biggest labor market we've ever had. We've got very low jobless claims. Almost no one is collecting unemployment. I mean, it's not almost no, it's like 1.4 million, but this is really low compared to where we've been historically. Weekly, 225,000 people losing jobs. Very, very low. We're in a pretty good spot. We have natural gas here. It's not going to be a problem the way it will be probably in Europe. So they're going to have some real problems. So as I think about what the 80-20 is, I still think the 80 is all the stuff with Russia and the energy problem. And everything else either just piles on and I think we're going to see more piling on of other problems and concerns. Please.
So I have a quick question.
Sure.
When you showed the charts, obviously, the mix is not the same, right? So where we are today, we have the gig economy, which we didn't have previously. Yeah. And so when you look at the disconnect between the overall unemployment rate and then the number of jobs that are open, do you think that's a function of the fact that, the mix again in the jobs that are open is different? So for example, service industry, hospitality industry, that's where there's this big demand relative to, let's say, the non-service and the non-hospitality jobs. And so when there's a recession and these organizations and these enterprises take action, how detrimental is that going to be?
So thank you for the question. So a couple of things, and one just is, in the last 2 years, tens of trillions of dollars of wealth were created. When that happened, every company wanted to hire, to grow, and that's where the demand has come from. We had entire industries appear out of nowhere that now need lots and lots of people. And you have the whole gig economy, influencer economy, all those other things kind of rising at once. So as I look forward, I think I'm still most concerned that there aren't enough people in trades, construction, manufacturing, supply chain, and that there might not be a big pipeline because of the demographics of folks who are leaving the workforce and then wondering where do the next wave of workers going into those sectors come from. So I think those are probably, the biggest questions with the companies I talk to. Hundreds and hundreds and hundreds of manufacturing jobs that are open at individual facilities, let alone nationally. Just massive job openings. Where do those folks come from? That's tough. And I don't know if that gets better, right? And you might have, in this cycle, you might have all the unemployed crypto bros you can shake a stick at, and you won't have any truck drivers. and you'll still wait for industrial equipment for over a year, even though we're in a recession.
So it is a mixed issue, isn't it?
I think some of it is, I mean, there are a few issues at play. One of the issues is all the in-person jobs never stopped going, and they had the biggest orders and growth in their history in the last couple of years. And they can't hire enough people to do it. Meanwhile, they're competing against remote work jobs and knowledge work that pay a lot more, and they're not as labor intensive. And then you've got people over 55 leaving the labor force when they've been the biggest part of the baby boomers, the biggest generation here, leaving. It's a mix of things, but where do those next wave of workers come from? This is a big question. And I'll tell you that all the talk on Capitol Hill now and a lot of the talk around most executive groups that I talk to tends to be around workforce, upskill, reskill, and comprehensive immigration reform, which is really tough to get to, but thinking about how do you have more, right when the economy is this tight, how do you have more workers? Because when we saw the unemployment rate skyrocket in the opening months of COVID, we dialed down the number of folks that could immigrate here and have visas to work here. Now we have a crazy tight labor market. So what do we do about that?
Yeah, that's my follow-on
Sure.
question to Shubi's point is, the birth rate is lower.
Yep.
It continues to decline. Immigration has become so much harder. And so specific to Texas, it's really compelling to sit here in Austin and see the growth. But the concern then around Austin is already an incredibly tight labor market. We're not having, more people come into the workforce in the same way, both from a birth rate and immigration. How does that impact Texas overall then?
So I think there are a few different issues. I mean, I think Texas overall still has 1,000 people a day coming to Texas, and Austin has like 1,000 people a week moving here. So there's plenty of people, but as Evan Smith has often commented, they're not bringing the roads and water and schools and infrastructure with them, right? Anybody drove here today, right? Anybody notice that, right? So those issues don't get better. Those remain problems. But we're still going to be able to attract people here, especially if we're competing with California. Now, nationally is a different question, but there's a tax arbitrage. And no matter whether the unemployment rate is 2.9 or 4.5 or 6.5, we're going to have a lower tax regime here and a lower cost of living than California. You're going to have people moving here. And I think that's likely to continue. As for long-term growth, the higher cost, and this is something I've often done projects with some companies in town around, is who can afford to live within a reasonable proximity of where they would need to work for certain jobs. And so this kind of ties into the question about the labor market. The most challenging part of the labor market in the past year has been folks in the lower income levels. Because at first the stimulus checks were good and the low interest rates were good and everything was cheap and there was money, but now everything's expensive and the folks in the lower income quintiles are the least able to bear the burden of significantly higher costs of, say, food and energy, which is also something we see in emerging markets. So those challenges are really big, and I don't know if you've seen this, but some companies I work with, they've had workers coming up to them when energy prices, oil prices were really high this summer, saying, hey, I need a raise today, or I can't come back to work tomorrow. And those kinds of dynamics are happening less now than they were in the summer, but that's going to be an issue, is what is the overall cost of labor here? It's probably going to continue to rise, along with property price and everything else.
Jason, thank you so much.
Thank you, Jen.
This has
Thank
been
you all.
amazing.